Remember when mortgage rates dropped so low, it felt like free money? People were buying homes, refinancing left and right, and the housing market was on fire. Fast forward to today, and rates have swung to 20-year highs, shifting the entire real estate landscape. If you've been confused, frustrated, or just trying to time the market, this video is for you. We are breaking down the entire story. What actually happened to mortgage rates from 2020 to mid-2025, and what it all means for you moving forward. Hi, it's Christopher and Brooks Marb, Energy Real Estate Advisors, your local Orange County realtors, with a full timeline of what's happened with mortgage rates since the beginning of COVID. In this video, we're going to walk you through every major shift in mortgage rates since the start of COVID. We'll look at the historic lows of 2020, the buyer frenzy of 2021, the sudden spike in 2022, the roller coaster of 2023, and the ups and downs of 2024, and where we stand so far in 2025. Along the way, we'll talk about how these changes impacted the housing market and what it meant for buyers and sellers, and what you need to watch for moving forward. March to December of 2020, pandemic panic equals record lows. When COVID hit in March of 2020, it didn't just slow the economy, it froze it. Uncertainty was everywhere. To keep things from collapsing, the Federal Reserve slashed interest rates to near zero and started buying mortgage-backed securities at an unprecedented pace. Mortgage rates tumbled under 3% by summer, and by December of 2020, we hit 2.68%, the lowest ever recorded for a 30-year fixed loan. This was life-changing for buyers and homeowners. People who never thought they could afford a home were suddenly in the market. Millions refinanced, freeing up hundreds or even thousands of dollars per month. The housing market caught fire almost instantly. In Orange County, bidding wars became the new normal, and prices began climbing at speeds we hadn't seen in over a decade. 2021, the Goldilocks years. If 2020 was a spark, 2021 was definitely the explosion. Rates stayed low, hovering between 2.7% and 3.2%, and that stability gave buyers unmatched confidence. The pandemic had also changed priorities. People wanted bigger homes, more outdoor space, and in many cases, they could work from anywhere. That fueled migration patterns and intensified competition in desirable markets like Orange County. Homes were selling in just mere days, sometimes hours, often with 10, 15, or even 20 offers over asking. Buyers waived inspections, offered huge non-refundable deposits, and wrote emotional letters to win over sellers. Sellers, on the other hand, were seeing prices jump every month. The market was in full fear of missing out mode. But underneath the excitement, affordability was quietly slipping away. Home prices had surged far faster than incomes. And then came 2022, the turning point.
Everything changed in 2022. Inflation, which had been building through 2021, became impossible to ignore, rising to levels not seen in over 40 years. It was now undeniable. Inflation was not transitory. The Fed had to act, and they did so with force. Starting in March, they raised interest rates repeatedly, sometimes by 0.75 of a point in a single meeting, the most aggressive pace in decades. Mortgage rates reacted instantly, jumping from the mid 3% in January to 6% by September, then breaking 7% by October. The speed of the increase shocked buyers and sellers alike. Homes that felt affordable at the start of the year suddenly required hundreds, if not thousands of dollars more per month in mortgage payment. Now, buyers froze. Sellers held on to their low-rate mortgages, and the bidding war era ended overnight. It was the moment the market shifted from white hot to cautious. 2023, volatility and confusion. If 2022 was a year of shock, then 2023 was a year of frustration. Rates bounced between 6 and 7% for most of the year, with the release of every inflation and jobs report, as well as Fed press conferences sending rates swinging up or down. Buyers were constantly asking, should I lock in now or wait? And many missed short-lived opportunities when rates dipped for a week or two. Sellers, especially those who bought or refinanced during the 3% era, were reluctant to give up their historically low fixed-rate payments, which kept inventory low. The result was a strange, frozen market. Homes weren't flooding the market, but buyers weren't rushing in either. Prices didn't collapse because supply stayed tight, but demand was far weaker than just a couple of years earlier. Everyone was waiting for clarity that never seemed to come. 2024, hope, then frustration. The start of 2024 gave buyers and sellers hope. Inflation data looked better and mortgage rates dipped into the mid 6% range early in the year. We saw a short burst of buyer activity, more showings, more offers, and more confidence. But just as quickly as it started, it stalled. Rates crept back towards the 7%, cooling momentum and leaving many feel like the market had pulled the rug out from underneath them. For much of 2024, we stayed stuck between 6.6 and 7%. High enough to keep affordability stretched thin, but not high enough to cause a dramatic market correction. Sellers had to adjust expectations, and buyers had to decide whether to keep renting or bite the bullet. It was a year defined by hesitation. 2025. So far, stuck in the middle. Now, over halfway through 2025, the market feels like it's in limbo. Rates have mostly sat between 6.5% and 7%, with occasional dips below 6.5% that trigger brief buyer activity. When those moments happen, we see open houses fill up, multiple offers return, but the activity fades fast when rates inch higher again. Demand is stronger than last year, but still far below normal. Inventory remains tight as many homeowners are still locked into their low rate loans. The big question everyone's asking, will the Fed finally cut rates by the end of the year? Or are we looking at the new normal where 6 to 7% is here to stay? The answer will shape the rest of 2025 and beyond. In just 5 years, we've gone from the lowest mortgage rates in US history to the most volatile market in recent memory. Rates didn't just move, they whiplashed. And those moves reshaped everything. How much home people can afford, how often people move, and even how long they stay put. For buyers, the key is readiness, because opportunities show up fast when rates dip. For sellers, it's about pricing realistically and working with agents who understand how to navigate these conditions. The market is still moving, but it rewards those who are prepared. If you're thinking about buying or selling and want real guidance, not guesswork, reach out to us directly. We'll help cut through the noise. If you found this helpful, like this video and subscribe for more. And if you're thinking about buying or selling in Orange County, reach out. We're here to guide you with facts, not fear. Thanks for watching, and we'll see you on the next video.